The United States, known for its economic prowess, finds itself grappling with a fiscal conundrum that seems to deepen with each passing day. The issue at hand is not just the sheer magnitude of the national debt, but also the increasingly unsustainable trajectory of fiscal policies. As of now, America's debt-to-GDP ratio stands at a staggering 123%. This places it among the highest globally, a testament to the mounting financial obligations that have accumulated over decades. The situation is further exacerbated by the policies of the Trump administration, which, according to many economists, are expected to add to the $2 trillion deficit inherited from Biden. For context, the deficit run by Biden last year was an eye-watering 6.4% of GDP, the largest among OECD countries, second only to Israel, and significantly above the 2% average seen in other advanced economies. The discourse surrounding America's fiscal health is far from novel. For years, experts and policymakers have warned of the unsustainable debt levels. In a recent statement, Treasury Secretary Scott Bessent expressed an aspiration to reduce the deficit to 3% of GDP by the end of Trump's term. However, with the looming threat of a recession and a notable rise in Treasury yields, the fiscal landscape appears more precarious than ever. This has sparked speculation about potential unorthodox solutions that President Trump might resort to if the fiscal burden becomes untenable. Several factors contribute to the worsening fiscal scenario in the United States. Firstly, the rise in U.S. bond yields has been a significant concern. Traditionally, during economic turmoil, borrowing costs for the U.S. tend to fall as investors seek the relative safety of U.S. government bonds. However, the recent turmoil, attributed to Trump's unpredictable policies, saw an unusual trend where Treasury yields actually rose. This signals that investors are pulling out of the U.S. market entirely. Although yields have somewhat stabilized, they remain high by historical standards, making it costlier for the U.S. to issue new debt in service the existing $36 trillion debt. Debt servicing alone costs the U.S. approximately $1 trillion annually, a figure comparable to the national defense budget. The risk here is entering a debt doom loop, where servicing costs necessitate further borrowing, thereby increasing future servicing costs. The second factor is the economic slowdown, which has become more pronounced due to unpredictable tariffs imposed by the Trump administration. These tariffs have dampened both consumer and business confidence, stalling growth, and heightening the risk of a recession. The IMF, reflecting these developments, has downgraded its growth forecast for the U.S. from 2.7% to 1.8%, estimating a 40% probability of a recession within the year. Economic stagnation or recession would further strain the fiscal position by increasing unemployment, thereby raising welfare spending and reducing tax receipts. Another dimension to this crisis is the failure of initiatives like Doge to significantly reduce public spending. Despite initial optimism, Doge has proven ineffective, especially with Musk's withdrawal, leaving spending largely unchecked. This year, federal government outlays have surpassed previous years, save for the pandemic-induced spending of 2021. Inflation, driven by tariffs, is another pressing issue. Economists anticipate a marked increase in inflation in the upcoming months. For instance, Citibank forecasts headline inflation to peak at about 4% this year, up from about 2% pre-tariffs. While inflation can sometimes benefit indebted governments by reducing the real value of debt, the Federal Reserve has indicated that rising inflation will likely lead to higher interest rates. This, in turn, would escalate servicing costs for the government and could further slow down the economy. Lastly, the budget reconciliation bill currently being advanced by Republicans in Congress poses a significant fiscal challenge. It includes extending the tax cuts introduced by Trump in 2017, which could add an estimated $5 trillion to the deficit over the next decade. While congressional Republicans propose offsetting about $1 trillion of this through spending cuts, these cuts would likely impact Medicare and Medicaid, conflicting with Trump's commitment to protect these programs. Should Trump veto these cuts, it would widen the deficit and signal a lack of political capital to enact meaningful spending reductions in the future. Given the current trajectory, America's fiscal position, already fragile before Trump, is poised to deteriorate further. This escalating debt burden, coupled with Trump's apparent reluctance to implement politically difficult spending cuts, has fueled speculation about possible unorthodox solutions. Among the ideas being floated are firing Fed Chair Jerome Powell to force a cut in interest rates, compelling nominal allies to purchase more U.S. government debt, and unilaterally extending the maturities on America's outstanding debt. While these ideas might offer temporary relief, they risk undermining confidence in U.S. debt and triggering a financial crisis. In light of these challenges, raising taxes or cutting spending, as seen in other parts of the world, might be the more prudent approach. However, the political landscape in the U.S. makes such measures contentious and difficult to achieve. As we delve into these complex issues, we encourage you to engage with the content. If you find value in our analysis and want to stay updated with the latest developments, consider subscribing to our channel. Your engagement, through likes and comments, helps us continue to provide insightful content. We also want to hear from you. What are your thoughts on the current fiscal policies and the potential solutions being discussed? Do you believe an unorthodox fix could be viable, or should traditional measures like tax increases and spending cuts be prioritized? Share your opinions in the comments below.